Okay, we're going to talk about some capital lease accounting here. And basically, capital lease accounting is just a method of financing. So, for most part, we are going to treat the accounting for this just as if we had borrowed the money from the bank. Okay, same thing. We're going to record depreciation expense. Okay, we're going to record interest expense on the loan, and we're going to reduce principal on the payment. So that's the main thing of capital lease. Capital leasing is just like we're financing the deal. Okay, it's just another way of financing it. So let's look at 15.6 here, and we have a company that leased a packaging machine. They completed construction of the machine on January 1st, 2009. The lease agreement for the $4 million, which was the fair value of the machine, specified 4 equal payments at the end of each year. Okay, at the end of each year tells us that we know we're going to be using an ordinary annuity. Okay, the useful life of the machine is expected to be 4 years with no residual value, and we would be using straight line depreciation for this. The useful life of the machine was expected to be 4 years, no residual value. Their implicit interest rate was 10%, okay, which is also their borrowing rate, which is the interest rate we're going to be using for figuring out the amount of our lease payment. And remember, on lease payments, hopefully you had this in finance, but we can go either way with the value of this on using our annuity tables, present value tables. So our first entry is going to be prepare the journal entry for American Food Services at the inception of the lease on January 1st. Well, it's really a straightforward entry here. We are going to go leased assets of $4 million. And we will be crediting our lease payable for $4 million. That's all to that. Second would be, it's asking us for a amortization table, and what we're going to do there is we're going to use our present value of an ordinary annuity tables, which is in the back of your book, or you can use your calculator, that works too. Okay, so that would be if you're looking at the book, at your intermediate accounting book, it's table 4 at the back of the book, present value of annuity, and you have an interest rate of 10%. We have 4 periods because there's 4 payments, or 4 payments that we're making, and so we look up that value, go across to 5%, or excuse me, to 10% on the table, 4 payments, comes down to a value of 3.16987. Okay, so to figure out what our lease payments are going to be, it's just going to be 4 million divided by our present value of an ordinary annuity of 3.16987, and that amount is equal to 1,261,881. So that's going to be our payments that we're going to have to make. If we were to be doing this the other way, so if we just knew the lease payment of 1,261,881, we would take that times that same present value of a ordinary annuity rate. So it'd be 1,261,881 times that 3.16987, and that would give us our $4 million. It works both ways there. Okay, and then our amortization schedule. This is our payment, the 1,261,000. The amount of interest of that payment is going to be the amount that we owe just on any loan. So our first one would be equal to 4 million, which is our principal left, times our interest rate of 0.10%. Okay, 10%, or 400,000 would be our interest. So out of our first interest payment, we would have 400,000 is going to be interest, and the balance of $861.81 would be reduction of principal, and we would just go from there. So our principal balance would be $4 million minus that, and there we have it. Okay, then let's go ahead and record the entry for that first year's interest payment or lease payment. We are going to debit interest expense for our $400,000, and we are going to debit our lease payable for the $861,881 reduction in principal. The balance remaining, or then of course we're going to credit, we're going to credit cash, $1,261,881 for our lease payment. If we were to have, if we were doing all entries that are affecting the income statement, we would do our depreciation expense. Okay, so we'd just calculate that. Straightforward, however, whatever method we had chosen, our normal depreciation, just as if we had bought the equipment outright. Okay, our second year, so if the next year we made, let's go year 2, we would do the same thing. Okay, our interest, our payment is going to be remain the same, $1,261,881, so that's not changing. Our principal balance would be $4 million. So we're going to equal our $4 million minus the amount that we had reduced it by, so $3,189,000. So our interest is going to be that, the remaining principal, times our 10%. So $3,181,000. $313,811. The difference is going to be our payment minus our interest, or $948,069 is what we're reducing the our lease balance, payable balance, and that is all it's to our basic capital lease accounting.